Want to invest in a business that profits from the basic need for food? Looking for a yield that easily beats the market, backed by double-digit long-term dividend growth? Interested in getting a great deal on a great stock after it's fallen by nearly 40%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing basic food proteins to the world. Air, food, water. Which of those is most important? I'd say they're all equally as important since we can't live without any of them. It's hard to profit from air, but food, that's up for grabs. And this food company is benefiting from the rising demand for proteins across the world. That's what's setting it up so well for continued growth across its revenue, profit, and dividend. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Tyson Foods, Inc., which appear to be trading at a significant discount today. Tyson Foods, Inc., stock ticker TSN, is one of the world's largest processors and marketers of chicken, beef, and pork. Founded in 1935, Tyson Foods is now a $22 billion by market cap food colossus that employs more than 140,000 people. While Tyson Foods has sales in over 140 countries worldwide, U.S. sales represents approximately 84% of revenue. The company operates across the following segments: beef, 36% of fiscal year 2022 segment sales, chicken, 31%, prepared foods, 17%, pork, 12%, and international/other, 4%. Some of their major brands include Hillshire Farms, Jimmy Dean, Ballpark, and the eponymous Tyson. Sales by channel are split across the retail channel, 44%, food service channel, 41%, and international channel, 15%. We have a very simple investment thesis here. People have to eat. If you don't eat, you don't survive. Going beyond the basic necessity of it, most people usually want to eat the best food they can get their hands on. That often leads to proteins. There is built-in demand present, but this built-in demand is also rising. That's because the world is growing wealthier on average. When people gain access to more financial resources, they tend to consume more meat. Simultaneously, our species continues to gain in number. The global population of humans recently crossed 8 billion. More people means more base demand for food. All of this works in the favor of Tyson Foods as they're one of the world's largest processors of meats. And that's exactly what gives them excellent prospects for continued growth across revenue, profit, and the dividend. To date, the company has increased its dividend for 12 consecutive years. The 10-year dividend growth rate of 27.7% is fantastic. However, more recent dividend increases have been in the mid-single digit range. On the other hand, the stock's current yield of 3.1% is a full 100 basis points higher than its own 5-year average. As dividend growth has slowed, the yield has risen, and I don't see that as an unfair trade-off. With the payout ratio at only 21.5%, Tyson Foods has a healthy dividend that can be raised at a healthy clip in the years ahead. I like dividend growth stocks in what I refer to as the sweet spot, a yield of between 2.5% and 3.5% paired with a high single digit or higher dividend growth rate. We're clearly in the sweet spot here, especially if we lean toward the long-term dividend growth track record. I like these dividend metrics. Looking at business growth, Tyson Foods moved up its revenue from $34.4 billion in fiscal year 2013 to $53.3 billion in fiscal year 2022. That's a compound annual growth rate of 5%. Good stuff. I typically look for a mid-single digit top top-line growth rate from a fairly mature business like this, Tyson Foods is dead on the mark. Meanwhile, earnings per share grew from $2.12 to $8.92 over this period, which is a compound annual growth rate of 17.3%. This is remarkable bottom-line growth. However, much like the dividend growth story we already went over, it is somewhat misleading. That's because very recent bottom-line growth hasn't been nearly as strong. Tyson Foods produces surprisingly lumpy earnings per share growth, so the impressiveness, or lack thereof, of its growth largely depends on which period you're looking at. The company has been benefiting from outsized margins, particularly on beef, over the last 2 or so years, but this appears to be reversing course now. Looking forward, CFRA forecasts that Tyson Foods will compound its earnings per share at an annual rate of -5% over the next 3 years. Negative growth is obviously not something I ever want to see. However, this isn't a business that's in decline. Instead, it's simply a normalization of operations. I don't necessarily see any problem with that. This near-term margin compression is central to understanding the stock's 30% drop in just 2022. The market is a forward-looking mechanism, and it's trying to price in turbulence and weakness at the business. CFRA goes on to state, and I quote, "Operating margins in beef, pork, and prepared foods have been weakening over the past few quarters due to high input costs and weakening demand. Beef in particular saw outsized margins for the better part of 2021, but now we're seeing beef margins normalize, which we expect will continue over the next 12 months, unquote. Management has anticipated this drop in profit and gotten out ahead of it by reducing the size of dividend raises. If the company were instead to aggressively raise the dividend against the headwinds, that could set investors up for a dividend cut down the road. Overall, I think Tyson Foods is easily capable of producing high single-digit dividend growth over the long run when you average things out through the cycles. The next year or two will almost certainly be below trend when it comes to dividend raises, but I see things picking up nicely when looking out into fiscal year 2025 and beyond. Plus, investors are starting out with an above-average 3.1% yield. I'm a fan of that kind of setup. Moving over to the balance sheet, Tyson Foods has a really good financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is north of 12. The balance sheet is a strength. Profitability is another strength, although recent margin expansion is set to reverse course. Over the last 5 years, the firm has average annual net margin of 5.9% and annual return on equity of 18.5%. Tyson Foods is operating a simple-to-understand business model that is benefiting from rising demand for proteins. As long as human beings need to eat in order to survive, which will always be a sure thing, Tyson Foods should make money. And the company is protected by durable competitive advantages that include economies of scale, an established global distribution network, and brand power. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Tyson Foods is largely a commodity producer, which creates more price taking than price making. Input costs can be volatile, and these costs have been rising. Viruses like flus are fairly common among animals, and these can cause massive harm to herd or flock health. A trend toward alternative food products like meatless meats can challenge the business model. Margin compression is a threat to near-term profit. Tyson Foods is mostly exposed to the US, but it does have some risks around currency exchange and foreign markets. Overall, I see these risks as quite acceptable, especially when weighed against the basic need for food. And with the stock down nearly 40% from its 52-week high, the valuation makes this idea especially compelling right now. The stock is trading hands for a price-earnings ratio of 6.8. That's one of the lowest earnings multiples I'm aware of. This stock never really commands a premium valuation, but this is much lower than usual. Earnings are set to go backward, but the market is almost pricing in a complete collapse in the business. For further perspective, we have a sales multiple of 0.4 that is quite a bit below its own 5-year average of 0.6. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This rate looks aggressive or conservative depending on what you're comparing it to. The long-term trajectory of Tyson Foods in terms of both EPS and dividend growth is far higher than this, and the payout ratio remains low. However, the last 3 dividend raises all came in below 7%. In addition, earnings per share is expected to decline over the foreseeable future. This means that Tyson Foods will be relying on and expanding that low payout ratio through this quote-unquote air pocket. I think the next few years could be pretty meager on the dividend increase front, but we could be looking at a nice acceleration in dividend growth once profit fully recovers. I'm averaging things out through the cycles. The dividend discount model analysis gives me a fair value of $68.48. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates TSN as a 5-star stock with a fair value estimate of $102. CFRE rates TSN as a 3-star hold with a 12-month target price of $75. I came out low this time around. Averaging the three numbers out gives us a final valuation of $81.83, which would indicate the stock is possibly 35% undervalued. Here's the bottom line, guys. Tyson Foods Inc., stock ticker TSN, has built-in demand from the basic need for food, and it's building upon that with rising global demand for proteins. It's difficult to imagine a future in which Tyson Foods doesn't make money. With a market-beating yield, a double-digit long-term dividend growth rate, a low payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 35% undervalued, long-term dividend growth investors should consider scooping up this name while it's in the bargain bin. And now for a special news announcement. Nike Inc., stock ticker NKE, just did it again. Their Q2 report, which came out only days ago, was a doozy. Easy beats on both the top line and bottom line, with revenue up 17.3% year over year. This report sent the stock higher by 12% on the day of the report. We just covered Nike, highlighting it as one of the best dividend growth stocks out there. Some of the comments in that video were talking about how expensive the stock was. Well, it's even more expensive now. Look, you tend to get what you pay for in life, and when you pay up for Nike, you're getting a world-class business that continues to execute. Don't sleep on Nike. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.